Hi, this is Dan at Master Trader, and in this video we're going to define what a short Iron Condor is. In our option strategy series, we split up these strategies taught into directional and income producing. Short Iron Condor is an income producing strategy since we're selling premium. Just a couple definitions here that we're going to be using in this Iron Condor. What's an option? It's a contract allowing for the right to buy or sell the underlying during a specific time for a specific price. Call buyers pay money and have the right to buy. They're bullish. They profit when the stock goes up. Call sellers take the opposite side of that and they put that money in their pocket in exchange for the obligation to sell at the agreed strike price. That's a bearish pattern or strategy. When you buy puts, you're paying money and have the right to sell stock. You're bearish. You want the price of the stock to go down. Put sellers take the opposite side of that. They receive money and they have the obligation to buy at the agreed strike price. Bullish. So what's an Iron Condor? Neutral time decay strategy. We're selling an out-of-the-money bear call spread and out-of-the-money bull put spread. So come down here. It's a great strategy for range bound and high volatility. High volatility because we are taking in higher premiums. And we just want it to chop around in a range and the credit received is always our maximum profit. Then that just decays to zero at expiration. Our max loss, I'll show you on the next page, but it's the strike width less the money you put in your pocket. The break-evens are the short call strike plus the credit, and so that's if the stock goes up. And on the downside, it's the short put strike minus the credit. You can only lose on one side of these at expiration. So here's an example with the S&P Spider ETF trading at 220.58. So our at the money is 220.50. That's the closest strike. So we're going to sell in just arbitrarily, and you know, we obviously teach this in our course of which strategy is best for the pattern, what strike price, what expiration, etc. But in this example, we're selling a out of the money, $2 out of the money, $1.50 wide. So we go down $2 to 218.5. We're selling this one. I have mine defaulted for a 10 lot, so we're selling a 10 lot of this put, buying a 10 lot of this put, and look over here. This is a bull put credit spread. So this example, we have 25 days to expiration, and we're taking in $440 on this bull put spread. Then we're going $2 out of the money to sell a call option, 222.5. $1.50 higher. We're buying those call options to make this a defined risk trade with less margin. We're taking in $580 on this, even though we're logging this in the software as one order. So that way we put it in at the midpoint for all four of these legs. But look at this amazing ROI here. So selling both of these credit spreads, we're taking in a total of $1,000 and $1,020 on a 10 lot. Our maximum loss is $480 because we're only going to lose, if any, on one of these sides. So the difference of the strike price here is $1,500 on a 10 lot, less the $1,020 we took in. Our max loss is only $480. So as long as this stock trades and closes at expiration between 222.5 and 218.5, $4 range, we've made a massive 202% ROI. Hope that explains it and hope it piques your interest to want to learn more. Have a great trading day.